Thanks, Phil. You said the interesting part of the evening, generally, we've been managing your fund for 5 years, and bonds are conceived by most people as the most interesting thing in the world, but I spent a lot of my career doing bonds. And when we've basically reinvented, with the committee's approval, your bond fund, we added some changes that make it a little more interesting than just your normal plain vanilla bond fund. So right now, as you know, interest rates around the world are extremely low. In fact, in some countries, you actually have to pay a government to buy the bonds. There's $7 trillion, that's with a T, of government-guaranteed bonds around the world that now trade at negative rates of interest. So you basically get less back when the bonds mature than you give the company or the government when you start. And this has all been an attempt around the world to stimulate growth. It has worked in some areas, in some countries. It's not working relatively well in Japan. But in general, interest rates are extremely low, and we're trying to find ways with your portfolio to add return. And the way to do that with other fixed income types of instruments are add higher yielding common stocks and preferred shares. So as you can see, on a year-to-date basis, nominal returns around the world, you know, the equity markets have been quite negative, and you'll see year-to-date hasn't been great, but we've beaten the benchmark. As you can see, 2.2% on your fund from the end of December to compared to the FTSE TMX bond index of 1.4, so that's a yield pickup of 0.8% or 80 basis points. Through time, as you see, since inception, over on the far right, the total return of your fund's been 5.6% compared to the bond index of 5.2, which is about 0.4% or 40 basis points added return, which in bond land is seen as a fairly good rate of return. You can see the 15 and 14 numbers when bonds really did extremely well and the equity component preferreds did less well. That would be expected, but we're seeing a big turnaround right now, especially with the preferred shares and the corporate stocks. As you can see on the bottom level, you can see just the return on your Canadian equity portion of your fund. Those yields, those returns have significantly beaten the Toronto Stock Exchange. Now, obviously, the bond fund, with the fact that we've added preferreds and common stocks, isn't going to be like the FTSE TMX bond index, which is over the right set of circles. You see the FTSE TMX has many more government bonds. We have, it doesn't own any preferred shares or common stocks, and that's what makes us different. But it also diversifies the portfolio, so you're not going to get huge swings in return up and down as rates change or as the stock markets change. We're basically trying to, if one market is going up, the other market is going down, and you're earning that nice yield on the portfolio, which today is about 3.5%. Over time, since inception, as you can see, if we break down the returns on your portfolio, bonds have basically kept up with the index, and that's my intent. That's when we're running it. We're not trying to shoot the lights out with bonds, because we are taking a little bit of extra risk in preferreds and common stocks. So to earn about the same return as the TSX bond index on that portion of your portfolio, which is about 70% of your portfolio, we see as meeting what our internal targets. And then if you look at preferred shares have suffered, but we've done substantially better than the preferred market. They haven't really done, as well as common stocks. Obviously, as you can see, the return on the preferred share fund is 2.9 compared to the index of negative 1.4. And common equities, which are higher yielding, still good quality stocks, but a lot of them are smaller type of stocks and a little bit more diversified than your typical stock you'd find in a bond, in a stock index. But they've done extremely well as 8.9% return compared to 2.1, and that's compounded since inception. What are we seeing now? all the international economies are more interlinked, as you can see, as rates have gone down through the rest of the world, rates have gone down in Canada and the US, not to the extent of being negative rates, but they're extremely low levels. When I first started in the bond business back in the late 70s, interest rates were at 10% and they went to 18%, and people at the time thought they would never go below 10% ever again in their lifetime. Where today we see negative rates, that wouldn't have been even conceivable 25 or 30 years ago. Another thing, people think Canada is in really rough shape, but if you look at it compared to the other G7, group of 7 countries, the major developed countries, Canada's doing pretty well. In fact, over the last 3 years, it's had the strongest rate of growth of any of the G7 countries. Not a huge rate of real GDP growth, 1.5%, 2%, but still much better than areas, if you look at Japan, Europe, and even the United States, which seems to be weakening off a bit. As well, we've gotten used to a lot of extra growth coming out of China. China has started to slow, but we feel that over time, the weight of evidence suggests that the emerging world is going to be where growth is going to come from, and Canada definitely benefits from growth in the emerging world. In fact, if you plot the Toronto Stock Exchange against the emerging market index of stocks, they plot up and down pretty much in correlation, because really, as more demand is out there, more demand for commodities, Canada benefits. As well, we've all obviously benefited a little bit from the decline in the Canadian dollar, which seems to be stabilizing. But generally, outside of what you read in the press, Canada's doing it a lot better than you would expect. And we still expect somewhat modest rates of return on the portfolio, but we feel by adding preferreds, and preferred shares have done poorly, but a lot of the preferred shares we own in your fund right now are called rate reset preferreds. And they actually benefit if rates go up. What happens is when they come up, when a preferred rate reset preferred comes up for its dividend increase, you actually get a spread over Government of Canada 5-year bonds. So if Government of Canada 5-year bond yields go up, you'll get a higher dividend when that reset comes up. It's sort of counterintuitive, you think, because generally, if interest rates go up, bond prices go down. A normal preferred would act that way as well. But with rate resets, which have done poorly because people think that interest rates will never go up again in our lifetime, which we don't believe, but with that rate reset, you will get a higher dividend in the future if interest rates do go up. So there again, it acts sort of like a negative bond. If rates go up, you're going to have a capital appreciation in those rate resets, and it helps increase the rate of return on your portfolio. It's a long-term prospect. It's not for there to gain, double your money overnight, but it's really there to help you compound your money over long periods of time. And we have over 14% of the portfolio in that type of preferred share. That's pretty much it. As not much to add from previous years. We don't do a lot of trading. We're basically focused on earning a stable rate of return for you and to compound that rate of return